Okay, what we're going to look at here is something called, or methods of trading. We're going to look at the idea of discretionary trading versus systematic trading. Now, if you remember on Monday, I talked to you about the idea that you could actually use programs to actually help you trade, and we'll come on to that. And one of the things we're going to do here is provide you, if you want, a automatic trading program for you to watch over the course of the next couple, or the course of the next month, and see how an automatic trading system actually works. It's something that you can install and run on the demo accounts that hopefully you will all set up, and we'll cover this in a minute. But it comes to the bottom of the type of trading that you yourself are likely to want to get into. One of the things you've got, I think everybody's going to appreciate now or will do after they start trading for a reasonable period of time, is that in many ways trading is a particularly complex pastime. It can be very easy and can be also very complex. Now, we've picked support and resistance, Fibonacci, moving averages for a good reason, and the basis of this reason is that they're reasonably simple to comprehend. But as your trading career continues, I mean, for me, I've managed to make a successful trading career just using those elements as a way of making money, but they don't suit everybody, and different people will try different methods, and you will find as you go through there are multiple different indicators out there that will help you trade. We'll be discussing a few in a minute during this, but you can overcomplicate things, and there's a lot to learn if you're not careful. It's like any career. You know, trading is a serious business. It's not something you can just turn up to and suddenly think you're going to make a lot of money. You're going to have to work at it. The good thing is that if you actually do put the work in, there's absolutely no reason why every single person couldn't actually do reasonably well out of trading. The reason most people don't do well out of trading is they don't actually do the work or the research. They might spend a lot of time trading, but they're not actually looking at the reasons behind why things aren't working or the reasons why things do work. Some of the things that we're going to talk about not next week, on the following Monday, we will spend quite a lot of time talking about the psychology of trading and the whole process of trading. And in that process, we're going to talk about the importance of things like goal planning, the importance of things like running trading as a business, and the importance of precision and discipline, whether it be in the way you trade or in the way you prepare to trade. And all these things are incredibly important. In exactly the same way, if you were a sports star or any other profession, you would make adequate preparations. You'd have to do the same when you trade. So all in all, you know, there's a lot to do and a lot to get right to become a good trader. And that falls under the mantra of discretionary trading. There are other methods you can use to be profitable or to actually make some money while you're learning all of this, and that's to use automated trading programs. They're probably never going to make you rich, but what they might do is certainly provide you with an opportunity to be profitable while you actually learn to trade manually. And I'll be brutally honest, the best way to always trade is to trade manually. Now, what do I mean by manual trading? Well, this is all about the different names that are often applied to the two different ways of trading are discretionary and systematic trading. So what is discretionary trading? Well, discretionary trading is pretty much what we have been talking about over the last couple of sessions. I mean, discretionary trading is really decision-based trading, where you yourself as a trader decides what trades to take based upon the information that the market is giving you at the time. Now, a discretionary trader might actually follow a structured trading system with particular trading rules, but what they will use is their discretion, hence the term discretionary trader, they will use their discretion as to whether to enter or not to enter the market. And that this is very, very important, because what tends to influence a success or failure of a trade is often what one describes as market conditions. Just as a point, why would you think that you would use your discretion to enter a trade? What market conditions might there be that would stop you entering a trade that you would normally enter? Anybody gonna? Tom? Yeah, you might find that the session itself is particularly volatile, so you might not be comfortable with taking a trade at that particular moment. There might be news about, there might be a rumor about, and all these things can affect the playing field that you are working on with regard, or playing on with regard to the trade that you're looking to take. So if, for example, we had today the ECB press conference, and what you will find if you had a look at the Euro chart, it will be quite volatile in and around the 1:30 to 3 o'clock time span. Euro would have moved, and I wasn't actually here for it, unfortunately, this week, but yesterday, but if you have a look back today on one of your charts at Euro, you will find that without me even looking at it, I will tell you that it moved quite a lot. So there are times when you will hold back and you would not necessarily trade your standard system. There might be other times whereby, particularly during Asian session, that market is very, very quiet. I mean, don't get me wrong, not always, the market isn't always quiet during Asian session. For example, today it was quite busy, but sometimes it can be quite quiet. And a lot of structured trading systems are based on a certain amount of price action. So you can have to a situation whereby you can have too much price action or not enough price action. What you really need is the right amount of price action. And that comes, and you learn that through experience. And that's what makes a good discretionary trader. So the key thing about discretionary trading, though, is it allows you to have much more control over your trading patterns, and you can more easily adapt to the different market conditions. But as I said, it's a constant learning process. Every day you learn something. And I've been trading 7 years and I'm still learning as I go along. I know people have been trading 15, 20 years and they still learn things most weeks, most days. The market is constantly changing. It's constantly in motion. And what would work today wouldn't necessarily work tomorrow if you overcomplicate your strategies. That's another good reason to keep things simple. One of the key things is don't necessarily optimize your trading strategy to be most profitable, and that might sound counterintuitive, but the problem with that is the market changes. So you might over a period of time find that if you've honed your strategy to be ultimately at its most profitable, you might find it'll fail more quickly than if you hone your strategy to be what one would describe consistent. So it's far better to have consistent profits than to try and hone a strategy that would maximize your profits. And as I said, that might sound counterintuitive, but because the conditions of the market are constantly in motion, and we'll look at this as we go along in a minute, and this is sometimes a problem with automated systems, is that because the market conditions are constantly changing and constantly in motion, what would work perfectly, let's say 5 years ago, might not necessarily work perfectly today. So one of the key principles is keeping things simple and optimizing for consistency rather than total profitability. Does that actually make sense to everybody? Good. Yeah. Excellent. Okay, so the other option is something called systematic trading. Now, systematic trading is literally a rigid rule-based trading system where the decision to make or take a trade is based on the actual system and not necessarily on market conditions. System trading decisions are absolute, i.e. once the criteria is met, the trade is made or taken no matter what actually is going on in the market. It doesn't really offer you any opportunity to decline to make a trade based on a trader's discretion. The appeal is that it's very, very useful in reducing emotional stress. Over a period of time, you're likely to make reasonable profits, and you can also, there's certainly a lack of, you can certainly sort of abdicate sort of personal responsibility. Also, it gives you sort of reasonably immediate results without years of building expertise. Now, let's just take one aspect of that trading, and that is the idea of emotional stress. Now, many of you, I don't know if any of you have actually tried to take any trades on a demo account or even on a real account, but has anybody actually tried to take any trades in the last few days, or anybody? Not yet. Okay. Do you find that your emotions change when you trade, Tom and Shola, even on a demo? Exactly. Good. Okay. This is probably the most important aspect of trading, and probably the most critical thing that's going to define whether or not all of you are successes or failures. Absolutely everybody here is eventually or reasonably is eventually or reasonably, I'll come to that in a second, Shola, but is going to be or going to come to a situation where they're going to reasonably understand how to create a trading system. It isn't too difficult, especially if you keep it reasonably simple. But ultimately, the biggest problem is going to be the psychological stress that trading causes. Now, it's particularly difficult with real money, but it's still there with demo money. You'll be surprised at the point that people will still get a little bit emotional even when they're not even trading their own money, which does smack. But this is down also to another aspect. It's not necessarily, or one of the key aspects, and something we will talk about, as I said, Monday week, and that is the role of ego in trading. And one of the things you will find is that being wrong and admitting to yourself that you are wrong is probably the hardest thing you're ever going to do. And the problem that you have with trading is just something you're going to have to do multiple times every single day. So I often say, who's the person you lie to the most? And the answer is usually it's yourself. So accepting you're wrong, even if it's only doesn't matter on a demo account, can actually be difficult. Now, women tend to be better than men at this, thankfully, which is often why they actually make better traders. They tend to be able to cope with the idea that they can be wrong, which might sound odd to some men, but they tend to be better at the emotional structure, the emotional side of trading. They tend to be able to get a better handle on it. So it's possibly down to the ego part. They're not. They don't necessarily have the same issues, but generally speaking, it is something that you're going to have to deal with, and you'll be. One of the things you'll get at the bottom of today's or tomorrow's email, which I'll send you out. Well, there are two types of right, Tom. As my wife says, she's always right, and even when she's wrong, she's right. That's typical. But when it comes to trading, it's a different type of right or wrong, because it's a personal right or wrong, so to speak. So so it's a different it's different in that respect. But as I said, the key point here is that is something you're going to have to get a grip to. Now we'll talk about this in a little bit of detail on Monday week, but and here's the but, it's such an important subject matter area that when I on this email that goes out tonight, you will or tomorrow. There'll be a book list, and I suggest that there's only 2 or 3 titles on there, but they're all dealing with psychological issues of trading and general psychological issues and the way people actually think. And it would be useful if people actually got hold of copies from libraries or whatever of some of these books and read them, because it'll do you the world of good. It's far more important for you to master your psychological trading than it is for you to master your the system that you're going to take, because you will always master the system, but the psychological side is much harder to get a grip of. So that's the area that you really need to spend time and effort on working on. Oh, well, that's good then, Martin. You probably have a lot of them, a lot of the books. And one, just as I made, is something called Thinking Fast and Slow. You might have actually read it, but it's a good book. It teaches you how we as humans actually think. And another one's called Trading in the Zone. And there's also actually a PDF download there, something called Prospect Theory, which is based on how people think in economic situations. But it's definitely something that you need to think about, because you'll discover quite quickly when reading these books how completely irrational we all are. None of us are rational at all in making decisions. We all think we're rational, but actually when we sit and analyze it, we tend to be completely and utterly irrational, which isn't good for what we're trying to do. So that's something that you'll need to approach and look at. But that's one of the appeals of systematic trading and automated trading. It takes, to a certain extent, provided you can leave it alone, and that's the hardest. A bit like automated trading systems can be a bit like sweet shops, probably the best analogy I can think of. There's hundreds of glass jars with wonderful sweets in sometimes, and that you have full access to, but you know full well you shouldn't be eating those sweets. The same thing applies to running an automated system or a systematic system. You need to leave it alone, irrespective of what you think it on or don't think it's doing. It's important that you need to leave it alone. Now, actually, the 2 systems aren't mutually exclusive. Once you become a little bit more experienced, what a lot of traders do, they run automated systems, but they make interventions. So they actually go and put their hands in these sweet jars, so to speak. But they know only to take the red ones, so to think, and not to eat all the blue and the green ones. Yes, and this is one of the things I'm going to look at, especially with the automated system I'm going to let you guys play with, because what it does is it looks for areas of support and resistance inside an existing range, and what it will do is it'll start to make you look at the orders that are pending on the system, and the idea is that you go to a chart and start to draw the lines on and look for where the system is picking out the rules with regard, also the areas of support and resistance, so you can see what it's trying to do. So it's an excellent way of actually learning. You know, it is a good tool for that sort of thing, and this is particularly why we've chosen this one. It's not necessarily the best DA you're ever going to come across, but it actually has a dual purpose here. The idea is that you actually pay attention to what it's actually doing rather than just letting it run. So that's very important. But as I said, the two things are not necessarily mutually exclusive. I mean, it ultimately becomes another discretionary system when you start to intervene. But it is important to know that once with a little bit of experience that you can actually make a huge difference. So you can take an automated trading system and intervene at times of news turning it off, for example. That would be a simple intervention when you know the market is going to be particularly volatile and it's likely to upset what's going to happen on the automated system, or by what does one call it? Or by just manually changing or exiting trades at certain points if you think that there's areas of support and resistance that the system isn't programmed to see. Now, I don't know, I think we talked on Monday about the program traders on television. I think Shola had seen it. Did you, everybody, for those who had actually seen that program, did anybody see the first program? There were two programs. There were one about what one just versus retail traders, but the first program actually, in my opinion, was far more interesting. It taught far more about well, one of the things you probably do you remember the bit where they went to Holland and saw the guy that was a lot of people complaining about these what they call sort of high frequency trading systems that are often employed by some sort of hedge funds and banks. And what you noticed is that, did you remember he said that they had lots of people, they weren't choosing the strategies, but they were making interventions. Did you see that bit where the guy talked about? So it wasn't a case of they just let this program run. You cannot necessarily, at a point you have to make certain interventions if you know what you're doing. You can let it run, but you can make more money if you know how to intervene, let's say, at certain points. And that was what this guy was. I mean, this guy actually, they were providing quotes and I think for people to take trades, but there was but basically had a huge massive data center that was producing the different using different algorithms to create these quotes. But there was a group of people that were adjusting constantly in a room above and take into account of news changes, market variations, etc. Yes, it was like a warehouse. So it was ultimately what one would call a systematic trading system, but with a certain amount of manual intervention. He called them mathematicians, he called them technicians rather than traders, if you recall. But still, they'd had to have some trading knowledge to be able to make any intervention anywhere. So the two areas are not mutually exclusive, but obviously the one we're going to look at is not something you necessarily want to start intervening with at this point. The idea is it's going to be a trading tool. Okay, so now we come on to the idea of what type of trades one can take. Now there are various types of trading or trades that one can do. And the first one we'll look at is short-term trading. Now, if you actually come to the main room, you will find that's pretty much what we do. We're looking at very short-term trades. Most of the trades that I'm in, or Kashif, or Chris, David, or Sam, or Engels, any of the other moderators are actually in, will be short-term trades. What I mean by short-term is that preferably they'll last only a couple of minutes, but they might last up to 15 or 20 minutes, sometimes a little bit longer, but generally speaking they're very short term, and these are often referred to as scalping trades. And discretionary scalpers will make a trading decision, albeit instantaneously, by looking at a chart. We have specific and special charts which you'll see, and it's something that next week you're going to do a lot of. Kashi is going to come in and talk to you about scalping and about short-term trading. Now, the attraction of short-term trading is that you're not in the market for a great deal of time. So it does help with the psychological side of things. So that's something to think about. Also, other people refer to it. Yes, of course you can. You just you can place orders for any type of trade you want, Shola. Often it's just a click of a button. When you look at a chart and you see a setup and you will click a button. It's knowing the setups. What you're doing is that, as I said, we have this specific type of software that we use, which you'll see, which Cash will talk about next week, which shows sort of 4 charts in one very small area. So basically you can see everything in a very, very small confined area. But the real point about it is that it provides you with also instant gratification to a certain extent. So you're in and out of the market, you've made your money quickly and you can go. Now, for people who don't have a great deal of time, maybe only have an hour here or an hour there, it's a very good way of trading. So if you've got an hour, sort of 7 to 8 in the morning, it's a very good way of making money. That particular sort of time span is a good time to be in the market as well, because Tokyo's closing, London's beginning to open, so you often have a reasonable price action at that particular time. Other times that we have good price, you need good price action for this type of trading, and other times that you have good price action tends to be in around 1:30 to 3 o'clock time span. So that's the other time. That's when New York is opening, and also there's lots of US news around 1:30 and 3 o'clock. So they're the times to spend scalping if you have time, or you can make those times. They're good times to come and look. And there's other times as well. Sometimes it's a question just looking at when news releases are likely to be, and then looking at the aftermath of the news release. So in Asian sessions, often looking at when either Japanese, Australian or Chinese news is coming out, you'll find that the market's pretty active in those periods, and good for scalping too. If there's no news coming out, you might well find the Asian market is dead and is not a great place for scalping. So there you have it. That's short-term trading. So a lot of people like it purely on the basis that there's not a great deal of time in market, and some people often describe time in market as risk, because the longer you're in a position, the more things that can happen, the more news events or unexpected things that could go wrong. So by keeping your time in market to as short a periods as possible, you have a good opportunity, and also you make your profits very quickly. I expect the best analogy is to look at it as like guerrilla trading, where you're in and out. You make your attack on the market, you're in and out, and disappear with hopefully you're winning relatively quickly. So that's short-term trading. Longer term trading, or what we call swing trading. Now this could be, it's difficult to put a time frame on it. Theoretically it could be trades which are held anywhere from a day to several weeks. It's sort of a similar style to day trading, which we'll talk about in a second. In a lot of instances, many of the same trading strategies can be used, whether it's short-term or long-term. The principles are the same, but you're just applying it over a longer-term chart. The thing about longer term trading is that you get what tends to happen if you're trading very short term charts like 1 or 5 minute charts. You have the biggest problem that you're likely to have is that you could find the extra volatility of the short term charts can cause you trading problems. Whereas when you start moving to hour, 4-hour, and daily charts, some of the what one describes as whipsaws, i.e., some of the more violent, volatile action actually doesn't really appear on longer term charts because it's happening in such a small space of time. So some people prefer it for that reason. So you have a much smoother ride, let's say, with regards to your trade. The other one is what one describes as position trading. So what do I mean by position trading? Okay, a position trade could be some trade that you might hold for months, maybe even years. This is often when you're using fundamentals. Now, if you remember, we talked on Monday about a difference between fundamental and technical trading. Now, if you're a fundamental trader, you'd pretty much be a position trader. You'll take a position on where you think the market is likely to go, looking at economic data. Now, you might take the position that I don't know, the US is coming out of recession. Its GDP growth is good. They're already tapering off their quantitative easing program. Interest rates are likely to rise, so you'll be bullish on the dollar. And if you had taken that position at the beginning of this year, you will have done incredibly well. You'd probably be up about 10% as the US dollar yen has started to move, has gone from late 90s through to 109. I think it nearly touched 110. So that would be a position trader, but it's a trade that's going to take a long time. You're going to have considerable periods of what one refers to as a drawdown in the trade. It's a bit like investing in a share. It's going to be reasonably erratic, but over a long period of time is going to be profitable. So it's what you call a set and forget type of trade, and I don't mean totally forget it, because obviously if the economic fundamentals change, you're going to have to get out of a trade. But it's a trade where you don't really tinker too much with once you've taken it. Does everybody know what drawdown is? Jürgen doesn't. Okay. Drawdown is a term used to look at or analyze your losses. Okay. So say, for example, you had $1,000 account, and after your first trade, or that's after your first 10 trades, your account was, let's say you have been very unlucky and your account is now $750 as you've made consistent losses. You would have what one would be referred to as a drawdown of 25%. Now these figures are important, especially when it comes to automated trading, because it gives you an idea of the risk that the position you are taking or the position or system you're taking can actually cause. So drawdown is a very, very important concept. It's something you must pay a lot of attention to when you're looking at your own stats for trading. It'll give you some information. Now everybody's going to experience some drawdown. Anything up to 10 or 15% is fine. Once you get over 25%, for me that's way too much risk involved in taking those particular trades, but some people are very happy with it. Some people are prepared to risk 50% and will accept drawdowns of up to 50%. The less your drawdown, the better your or your the less risk that you're going to employ, and ultimately the better your or the less likely, let's say, you are of blowing up or busting out. But as I said, much will depends upon your own risk appetite. Everybody's going to be different. Some people are very, very happy to run with high drawdowns. Others, probably like me, I hate the idea of drawdown, so I try and limit it and make it as little as possible. But obviously, if you're limiting your drawdown, you're probably also limiting the upside as well, because obviously everything's relative. So what you need to do is find systems whereby your profit to drawdown is at its greatest, what gives you the greatest ratio, and that probably provides you the safest way of trading. But it's, in many ways, the position trading on Forex is very much like stock trading or trading shares. I think some of you say that you traded stocks and shares before? Anybody who traded shares? And Martin, Tom, how did you trade them? Did you buy and hold? Were you buy and hold guys, David? David was a buy and hold guy. Not the rest. So you would hold the trade for a long period of time, all of you basically. You wouldn't buy a share at 9 o'clock and then sell it at 9:05. Yeah, so you're likely to buy a share on the 1st of January and still be having that share on the 1st of July type thing. You just want the dividends. Yeah, that makes sense. No, that's fine, because that's one of the advantages of dealing in stocks is the fact that dividends are paid. So obviously, yield is incredibly important. So obviously, all of you will be piling into Tesco shares now because of the yield. Yeah. Yes, you would. Probably. I mean, it's possible that a share could move quite considerably in a very short period of time as well. But you don't have leverage. That's the problem, and that's where the issue is. Whereas with Forex, you think you can get some leverage, but generally speaking, there isn't leverage employed. But the point is that position trading in Forex is very much the same thing. So, I mean, when you buy these shares, would you agree that there's often that you'll find a share, you're buying a share for the long term, and if a share moves up, let's say 10% during the course of your year, of the year, or 5% during the course of the year, it could also have in the course of that year had a period where it actually moved down before it changed to start moving up. Would that be fair to say? Okay. Good. Excellent. So this is the point of position trading. When you do this, you have to accept, and this is why I think I said the other day that if you're going to be a fundamental Forex trader, you need to ratchet down the leverage. You don't really want high leverage because you're going to give yourself heart failure, because there's going to be times when the share or the price is going to move down. I mean, particularly if you pulled up a dollar-yen chart for this year, you would actually find that there were periods of pressure for dollar, but overall it has moved up quite substantially. But you just have to accept that that's going to happen. And much is the same with regard to automated trading systems, which we're going to find out in a second. They work in a very, very similar way, and we will look at this now.